Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darcy here to bring you the daily recap. So the frustration continues to mount for traders as we had another very erratic session. In the daily recap article, which I started writing up before I jumped in here, I just followed the track of the market intraday, and I'll take a look at the intraday chart just so you can see why traders are getting frustrated if you don't focus so much intraday and if you're not as active of a trader. But if you are, I'm sure you're feeling it yourself. And we actually had a really good exercise in the T3 Live virtual trading floor today, where we had Mark Sperling and some other guys that have some really great experience in the market, have obviously been through frustrating times as well as good times, good environments for trading, just talking through how they approach a market environment when things are very frustrating, when there isn't a whole lot of follow-through, when you're ripe for over-trading. And it's all about stepping back a little bit, lowering your expectations, and just working on focusing on only those A-plus ideas that you see and really focusing on where the action is rather than having biases on stocks and trying to make money back in stocks that have been burning you and things like that, and being nimble and being flexible overall. So I think being in the virtual trading floor is just another example of a really positive thing you can get from that, not only from hearing from Mark and the other contributors from T3 Live, but also hearing from other subscribers who are experiencing similar things to you in terms of the frustration they're seeing in the market right now. But what we're seeing is, in fact, I'm talking about how it's a frustrating environment, and meanwhile the S&P 500 is trading basically at all-time highs. Today, if you look at the chart of the S&P here, you can see we were weak at certain points of the day, and it looked for a while like we were going to close with some decent losses today, but instead, in the final hour, again, like we saw yesterday, you saw a really nice rally into the close that almost took the S&P back to the flat line. But that sort of differs very significantly with the action that we saw again in tech, financials, small cap stocks. Those are all the sectors that traders like to see lead the way, and they like to trade those high momentum, high beta type stocks. And those are the sectors that are really showing a lot of damage. And you actually saw some really extreme damage in certain pockets of the market, certain pockets of tech in particular, that are just confusing traders right now, confounding traders right now, I think would be a good word for it, and just leaving people wondering what's next without feeling any real edge in the market. Yeah, the S&P is holding up, but the fact that these things are breaking down so significantly could lead maybe to a little bit of a pullback at some point. Once those sectors that are leading the way, like energy stocks and things like that, start to pull back a little bit, who knows what's going to happen. Money might not necessarily rotate into tech. It could just rotate out of equities in general. And again, we saw bonds actually perform decently well today. But I'll go ahead and take a look through sector rotation that we saw today again. And once again, energy stocks, like I mentioned, remain the place to be. And really strong action in the XLE, tacked on another nice chunk of gains. I mean, you take a look at a longer-term chart just to see what we're seeing here. You can go back to a monthly chart. This is now approaching these highs in the XLE ETF that we saw from early 2008. So if it can get above there, you could really see the XLE ETF get some momentum. And you've seen just a really strong uptrend since about the middle of 2011. It's been a lot more steady since the beginning of 2012, but really impressive action there from energy stocks. In particular, today, we saw really good price action from these independent oil and gas names. And I'll get to Anadarko in a second, but the ones that were strong, just to run through a few of them, Devon Energy, big tail after the Anadarko news came out. EOG was strong in the morning. RRC, nice move, a little bit lower level pattern than some of the other ones. Chesapeake, CHK, also with a little bit of a tail, but the sector got a bigger boost. APC is only about a 3% or so component in the XLE ETF, but what you had was some news came out with Anadarko. They had some ongoing litigation that they finally came to a settlement. I'm not familiar with the exact details of the case, but they finally settled just an ongoing legal dispute, maybe for a little less money than some people had feared the lawsuit might drag on APC. And it obviously ignited a huge igniting bar that did give a little boost to the XLE. It is only, like I said, a 3% or so component of the ETF, but definitely didn't hurt to see a stock, and this is about a 15% move in Anadarko back to up near its highs. So it looks like it was trading at a little bit of a discount to some of those other independent oil and gas names, and then today's move after they finally got some clarity on that legal situation took it back up there to near highs. So see a big igniting bar like this on news, it sort of changes the way you look at it a little bit, but if you get some sideways action here in Anadarko with all that weight off of its shoulders now that that legal proceeding is done with. Maybe it could continue higher, and the level you watch here is over here, around the $100 area. So it tried to break above it, or did break above it barely, and now with some sideways consolidation could continue higher. Basic materials in general performed well today, and you had some of those beaten down groups like steel, coal names perform relatively well and start to look a little bit better. Look at U.S. Steel, X, a little bit of a tail there, but you could call this a little bit of a bull flag after a bounce off the 200-day, some sideways action for about 2 weeks, and then a nice breakout move today. Like I said, a tail, not exactly what traders would like to see, but it is looking better, and I think you definitely could see U.S. Steel back here up in the high 20s near the $30 area, and then obviously the $31 level. If it gets up there, will be a major pivot to see if it can break above. But X did hold its 200-day back here in mid-February, which is very constructive, held it again when it tried to retest it, and then is acting better. So definitely something to keep an eye on there, even though it is a laggard. Could see some money rotate into these basic materials. AK Steel also acting well, just sort of trending higher, not really a sideways base to play off of, but just notable action there. Then an interesting pattern that caught some traders' eyes on the virtual trading floor today is Walter Energy, sort of a coal play, and see how much this has been beaten down. Even since just last November, this company is a little bit over-levered and having a lot of problems. You can see where it came from. Back from early 2011, this was a $140 stock, all the way down at $8. To say it's a laggard would be an understatement, but does have heavy short interest, is trying to get into this gap, and if it does start to get into more of that gap, I think you could see a squeeze, at least to fill the gap up here around 950, which would be a nice percentage gain given the price of this stock. And then obviously to the left, you have a lot of price action for it to retrace. I don't think you should have huge expectations on a laggard name like this. You can see how far away the 200-day is. But just one for a short-term type trade in an environment where money's rotating around, definitely something that people are watching and I think is worth keeping an eye on. Utilities were also strong today, held up relatively well given the fact that bonds were strong. TLT, after a few days of downside action, TLT got a little bit of a bounce today, something notable. And then jumping into tech, like I talked about, tech in particular is an area that momentum traders, active traders turn to because you do have good volatility, you do have good beta, it provides potential opportunity to have bigger gains and more instant gratification with trade ideas. And so traders like to see those types of stocks leading the market in order to focus on them and be correct in focusing on them. And I think traders have tried to focus on those, but they continue to act very weak and obviously diverging big time with the S&P. You just take a look at the Qs. Whereas you see the S&P sort of basing up here near highs, you have the Qs, and just today in particular, S&P finished around flat, Qs very weak, sort of a lethargic bounce off the lows. A weak bounce off the lows, didn't put in much of a bottoming tail at all. Back below its 8-day moving average, threatening to close back below its 21-day moving average. You sort of have, like you're seeing in a few tech names like I talked about this morning, you could call this a little bit of a bear flag, to be honest, where you talk about a breakdown off of highs, have been showing relative weakness. You sort of have a little bit of a flag here that if it breaks lower out of this little trend line, then you could see some more downside momentum. It's difficult on one hand because these stocks are very oversold. Tech stocks are somewhat oversold, whereas the market's holding up well. If the market breaks down, the S&P breaks down, these are already oversold. So it's, on one hand, you might not think that they could get more downside, but I think you just have to take a very stock-specific approach in the group to find the ones that are breaking down and just take a very balanced approach. But just looking at a couple names, look at Amazon. Obviously, been getting a lot of attention. They came out with that new Fire TV yesterday to challenge Apple TV. And I talked about, in the last couple of days, I talked about this being a bear flag for Amazon. And that's what it turned into today. Who knows what it's going to lead to. But you draw this little bear flag, had a breakdown down to his 200-day, paused, which is sort of very calculated action that we like to see from a short-term trading perspective. And then breakdown today did close a little bit off its lows, like the NASDAQ, like the Qs, but definitely looks like it could be headed lower based on some of the reaction to the recent news that's come out there. The Netflix, same situation. I talked about it in the same regard. Has been beaten down on news. We highlighted this rounding top pattern on off the charts. And then Apple, the news came out, them building a streaming service potentially with Comcast. And then you had Amazon coming out with their own new free streaming service, so a lot of competition coming in for Netflix, and it just continues to bleed lower. If it breaks below this pivot here, it comes in at 349.88, so around the $350 area. If it breaks below that, could get some more momentum. The next stop would be the 200-day, which will be a very important level because it also coincides with this little pocket of support back from early this year around 320. If it breaks that, which, you know, that'd be getting a little ahead of ourselves, but if it breaks that, you could see it down here below 300. So definitely something to keep an eye on there with Netflix, rounding top type pattern that doesn't really show much signs of life right now. Social media also continues to be a mess, and even the one that has been holding up best in that group, Facebook, is also succumbing to the pressure in that group. And you could also call this a little bit of a bear flag and a rounding top type pattern. We also highlighted this rounding top pattern on Off the Charts. It also met our downside target, so two really good isolated shorts that we found in the tech space over the last couple weeks there. But you go back to your line tool again, it was a little stronger than some of these other ones, but with yesterday's failure to tack on more gains, you could call that a bear flag. And then today broke down below it. Now we have like a similar setup that we have in some of these tech names. If it breaks above this or breaks below this pivot low here at 57.98, so just right around the $58 area, you could see some more downside momentum to fill the rest of this gap. And then the next stop would be potentially this pivot low here, which is around 51.85. Pivot low of this candle, 53.19. So the $51 to $53 area could be the next stop if it breaks below that pivot that we see with that bear flag on Facebook. Then Twitter's just an absolute mess right now. Twitter also looking like it wants to break down, but it's been weaker for longer. And if it gets momentum below its recent pivot low, which is 43.31, you could see it back to the lows, the area from which it traded right after its IPO. Obviously, the IPO was priced much lower, but it opened for trading about where it is right now. So you're seeing Twitter come full circle, and they obviously haven't done much to prove that they are maturing and doing what Facebook did to take the steps to become a mature company that focuses on making money. And as a public company, you have a little bit more of a responsibility to your shareholders, and Twitter hasn't exactly met those expectations. Their first earnings report was obviously very weak. Their next one will be very important coming up in about a month or so. But this one definitely looks like it's headed lower, and if we get down to this $40 area, that'll be a huge level, because if it breaks that, who knows where Twitter could go. But if it gets down there, I would be much more attracted to it from a long-term perspective, despite the murky financial future for Twitter. LinkedIn, even you could say it's even worse recently than Twitter. Actually, Twitter's been pretty bad recently, so it's hard to say it's worse, but these both have been really weak stocks. And as you can see on LinkedIn, just been in a very steady downtrend, descending channel. And now it's to the bottom of that descending channel. The question now is whether you play it for a range type trade where you say maybe it'll bounce off the bottom end of this descending channel, or does it accelerate lower? If it accelerates lower out of a descending channel, that is extremely bearish because it's obviously been fading, and to get even more downside momentum would potentially lead to a break here of this pivot around 160, and then nothing in the way of support until you get down into the 130 area. So the error really coming out of some of these social media stocks. And then Yelp, it's one we talked about in the morning call this morning, going back to a daily chart. Yelp really breaking down. And yesterday what we highlighted, or I highlighted in the morning call today, but in regards to yesterday's price action, a big bearish engulfing bar. A bearish engulfing bar is when a stock opens above the previous day's high or trades above the previous day's high and then closes back down below the previous day's low. And this was a really loud bearish engulfing bar. And those types of bars generally lead to lower prices. And lo and behold, what you got today was acceleration to the downside. This pivot here from late January is 69.80. If it breaks below that, next stop area to watch at least would be around 65, which is where the 200-day moving average comes in. But overall, the social media group just looking very weak right now. And among tech, the only stocks that are actually performing relatively well are select names within that old school tech group that we've been talking about, ones that pay a nice dividend and aren't these high beta, high growth type stocks. An example is Intel. This is one that we've had on Off the Charts as a long setup since down here below 25, just continues to plug away and looks like it wants to challenge highs up here around 27 in my opinion. So it's into this gap, it's filled this gap. And so beyond that, the $27 area will be the next key level for Intel. And for one of these dinosaur type stocks, that's a pretty nice percentage move down from that base around 24.50 up to around 26.50. And then QCOM was also strong today. A little bit of a tail, but just been trending higher over the last several weeks, sort of ignoring the choppy action that we've seen in the market. Within tech, there's a subset of security and data software stocks that a lot of traders have been eyeing over the past several weeks that have really gotten beaten down recently. And I'll just run through those really quickly. If you're a short-term trader, you're probably familiar with these because they've been some of the ones on the top of Momentum Traders' watch list. But FireEye had a huge move in early 2014, put in a king and queen candlestick formation up here, which is a bearish candlestick formation, and then gapped and had a gap and go to the downside. And since then, it's been tough sledding for FireEye, continuing just to bleed lower. And then yesterday, another one that put in a bearish engulfing bar, engulfed the previous day's price action, and then lo and behold, acceleration to the downside today, big time acceleration to the downside. Coming into a little bit of support here, and it's highly oversold, so I think a lot of people have been looking for a bounce in this name. It just hasn't been coming. I think, I hate to say it like this, but once a lot of those people just throw in the towel, that's oftentimes when you get the bounce. So when you see frustration boiling over and people trying to buy a dip in a name like FireEye, that's when you look to buy people's pain, something along those lines. And that's, I think, will continue to be the most prudent approach here. It's hard to short given how extended it is to the downside. But then Data, another name in that group, got hit really hard today after almost an engulfing bar yesterday, back into its 200-day moving average. Workday, big acceleration to the downside out of a bear flag looking type pattern back into its 200-day. Splunk, I like saying that one. Splunk, similar situation. You're seeing very similar patterns in these stocks. And then even CRM, a little bit more mature company and software as a service group, big acceleration to the downside today. So some of these look like they wanted to maybe break out of some descending channels, but then they got smacked right back down. Not healthy action at all. Just a few individual names that I talked about yesterday. GTAT, GTAT. Also, this is a stock that I like that is a little bit speculative, but I think the story is somewhat strong given their partnership with Apple. But yesterday put in a little bit of a tail as it tried to potentially break out, and then today filled a lot of that gap from yesterday that came after Goldman came out with positive comments. So I'm hoping for a pullback in this one to potentially buy it myself. If I don't get the pullback, so be it. I just won't be involved in the story. But if we do get a pullback back into the $15, maybe $14 area, I think it'd be a somewhat attractive buy, and this will be one I'll be keeping an eye on. But definitely the tail yesterday and the filling of that gap yesterday and during today's session, definitely not the most bullish action in the short term. And then the Plug Powers of the world, BLDP, the fuel cell stocks, is a similar situation where you had some phony news, old news hit the wires yesterday that was represented as current news and led to a tail and then gave back all those gains in today's session. And these are ones that I think eventually maybe they could have spikes here and there, but I think BLDP will give back some of these gains that we saw from late February. Then KNDI, another one that has an interesting story to me. I don't know too much about the financials of the company, but based on comments from other people in the industry, I believe that this is definitely another one of those big-time speculative names that benefits from the price action that we've seen in Tesla and the buzz we've seen around Tesla. They both do electric cars, electric vehicles. This is one of the bigger electric car makers in China. And you hear electric cars, you hear China, you combine those two stories. I don't think a lot of people are going to be looking at financial metrics. Just the story itself can propel this stock higher. But I think what people have come to realize is that this stock got a little bit ahead of itself, and it looks like it might want to head lower. A little bit of a sloppy bear flag type pattern forming, but I could definitely see this one head back down to the $14 area where it has some support from early 2014. Another group that is looking unhealthy, 3D printers. We have Triple D listed as a short on off the charts. Giving you this one a little bit early. Some of the other names from off the charts are ones that are closer to our target that have already started working out, but this is one that we added a few days ago as a potential short. Below its 200-day moving average, below all its short-term moving averages, showing very little signs of life, and you have a very defined support level here that it's bounced off a couple times. If it gets below the $55 area, I think it's a lookout below for these 3D printers. You talk about getting ahead of yourself. Look at this huge head and shoulders pattern that Triple D has put in and broke below that you could say it's an interesting head and shoulders pattern because you got this big gap down that it rallied back and reclaimed. You could talk about it being an even larger head and shoulders pattern with the neckline down here on 55, but not the cleanest head and shoulders, but some of the same similar type price action, and definitely one that I think could be headed lower down to that $50 area as its first stop, and then sort of some support down here at the $45 area. But the 3D printers as a whole looking pretty weak. XO&E, another one of the ones that's looking really weak there. Looking like it might want to break pivot lows and potentially accelerate to the downside. But that'll about do it for today's daily recap. I just continue to reiterate that this is a frustrating environment. Don't feel like you have to, if you are a short-term active trader, don't feel like you have to trade as actively as you do when you are on, quote unquote, when you're really seeing things clearly. And like I talked about, that discussion that happened in the virtual trading floor today I thought was outstanding. I thought it was very valuable for people to hear, just bouncing different experiences that people have had off of each other, including someone like Mark Sperling, who, if you've read The Modern Trader, which is a book about all the T3 Live partners, which I helped to write or wrote completely, the story of Mark Sperling is about how in the early days of his career he experienced some really heavy losses and some big-time adversity as a trader, and what really defined him was the way he bounced back from that, the way he slowly and methodically built himself back up, started getting green again, built his confidence, because the money factor, you can make money back, and you can have some winning trades that get your P&L back to respectable territory, or reclaim some of the losses that you might have gained or experienced from over trading. But emotional capital is also very important, and confidence and conviction is very important in trading. And if you overtrade during times that are very difficult, sometimes you can dig yourself an emotional hole that's even harder to get out of than the financial hole you dig yourself into. So just something to take note of there. And if you've never been on the virtual trading floor, we offer a 7-day free trial if you want to be a part of some of those conversations that I'm sure will continue over the next few days and few weeks as people try to build themselves back up after a very frustrating couple weeks of trading. But anyways, tomorrow the jobs report, I'll be back on the morning call probably after the jobs report so we can see the reaction, see the number. But it'll be very interesting to see whether that moves the needle with the market at all. I think despite, I don't think it really matters what the jobs number is going to be in regards to what the Fed's going to do. I think over a longer time frame, if we do get some really strong jobs reports, maybe 8 to 12 months down the line, we might start to see some rate hikes. But I think the Fed is very intent on $10 billion a month, tapering QE, winding that program down, and then going from there. But so far the market doesn't really seem to care, and the S&P doesn't seem to care too much, and some individual stocks are breaking down a little bit, but overall it hasn't been too much of a bother for the broad market indices. But this has been John Darcy, your Editor-in-Chief, here for the Daily Recap. See you back here tomorrow morning for the morning call.